please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Let's get you a lot of the opinion that we've been gathering through the course of the day. This is a CNBC TV18 exclusive. We caught up with Abhay Laijawala, head of India research at Deutsche Equities, and asked him whether he thought this market underperformance could continue and whether it was largely because of domestic factors. Take a look.
It's obviously started with the global cues, but now the domestic cues are also coming into play. Clearly, it is the expectation of what's really happening in the bond markets. I think that has also gone a long way in impacting sentiment. So when you have the term premium widening so considerably, it does lead to fears as to what really is happening on the macroeconomic front. And not everyone internationally realizes that the widening of the term premium is attributable largely to the virtual dysfunctional bond markets that we have right now. And I think once those issues ease out as the government's borrowing program begins in April, we do believe that the term premium should adjust. But what I'd like to say over here is that while sentiment is weak, the fundamentals are strengthening quite considerably as far as India is concerned.
Are you already a buyer with the market giving you 10% off its highs?
So, clearly sentiment right now is overpowering the fundamentals. And what we are seeing, as we've written on a recent report, is that since the middle of May and the end of 2017, it was always about sentiment overpowering, the sentiment overpowering the fundamentals positively, and now it's the reverse. Fact of the matter is that the economy is improving. You got the capacity utilization rates across different sectors moving up. In steel, the capacity utilization rate is 82%. In automobiles, the capacity utilization rate is high. In cement, demand growth in the third quarter was almost 14% or so. So aggregate demand in the economy is coming back. To answer your question specifically, Lata, the issue is the valuation. When the macro, overall global macro leads to the concerns that we are seeing, clearly there is a view that India's valuation or the market valuation is probably too high and needs to come down. So in our sense, we have to really see how this interplay between fundamentals and sentiment works out. It is likely that the valuation may come down. So our expectation for this year is earnings growth of roughly about 20% and a valuation derating of 10%, which still gives us a 10% growth for the market. As to what investors should do in the near term, wait and watch is the view. Having said that, at some point in time during the reporting season, we do believe that the fundamentals will reassert.
Okay, so is that why you have a target of, the target is flashing on the screen, 11,500 on the Nifty and 37,000 on the Sensex? And what part of the market do you think would lead that? Is it going to be secular or is it going to be again the banks which would lead the market?
Very good question. Clearly, unlike the last 2 years, it's not as much as a top-down market. It's likely to be a far more bottom-up market. And we think that the sectors that will take leadership are going to be the ones where there is certainty to earnings growth. I think this year, much more so than the last few years, it is going to be earnings growth that determines the sectors and the stock selection as well. In our view, consumer discretionary, private sector banks, and infrastructure are the three sectors that will probably take leadership. We expect earnings growth certainty to be the highest in consumer discretionary, private sector banks, where there is a potential for consensus upgrades in some of the select private sector banks, because these banks are actually taking market share very aggressively from the state-owned banks. Our banks analyst Manish Karwa highlights that about 8 years ago, the incremental market share of the private sector banks was 17%. That has now risen to 107%. The acceleration in the transfer of market share from the state-owned banks to the private sector banks has been brisk. And what is very important is that the private sector banks today are far more confident to take on the challenge and are beginning to shed many of their inhibitions and taking on risks. So I will not be surprised if loan growth at some of the private sector banks actually surprises consensus.